we've talked about this. We had a recent show about this. What the pundits are saying right now, and when you really look at the data and you look at the conditions, it's not that this next recession is going to be like 2007 to 2008, because that was a very unique situation. But there is another situation that the numbers do kind of like mirror themselves. And it was what happened in the early 1980s. You want to just give us a real quick glimpse into what was happening in the early 1980s?
Yeah.
And we can start talking about, okay, now let's look at that data because this is a good comp data.
Yeah, we had runaway inflation and in the late 1970s, and in the early 80s, we went into a recessionary period of time. But we had major demographics that were driving demand for housing. And that's kind of what we see right now, right? We had runaway inflation. In order to quell the runaway inflation, the Fed has raised the Fed funds rate, which affects all borrowing rates at every level of the economy. And so it's gotten more expensive to borrow for businesses and for people. And that is dropping demand for many asset classes, but it's dropping demand for housing. And the question is, what can we learn from the 1980s when it came to real estate? Because this market today is a whole lot more like the early 1980s than what many people are comparing it to. Many people are comparing to the early 2000s.
That's right.
But this is a very different market than the early 2000s. So I did some digging. Guess what I did? I started to get knee deep into the research.
Let's go.
And I just love comparing this and using data that is helping us understand where we are in this market. And we have a great comp, right? I'm really thankful that we actually started to get really great data really in the beginning of the early 80s. So I started to run the numbers here, guys. So from 1978 to 1982, and this is for all of the US, would you believe that home sales declined 50%? Home sales declined 50%, but home prices increased 44% from 1978 to 1982. And 82 is when the recession actually happened. So just take that for a second here. All of these headlines that you all have been reading for the last year and a half, and really I see the headlines, I've seen it for the last 10 years of real estate has crashed, real estate will crash, real estate has crashed. It's all a variation. For the last year and a half, they have been talking about home sales volume going down.
Slow down in the market.
Slow down in the market.
Yeah.
Slowdown in home sales is not the same thing as a slowdown or a decline in home prices.
That's right.
It's very big to separate that. So you can have home sales.
Why is that, GC?
Well, whenever we're analyzing a market and we talk about a crash or a bubble or anything in between, we're talking about the value of the asset. We're not talking about the velocity of the trade. The velocity of the trade is the sale. But it's totally possible for your sales volume to go down, but your price or value of the asset to go up. But somewhere along the lines in real estate, people confuse that. It's the only asset that people confuse that about for some reason.
Yep.
And it makes the headlines. But it's very possible for you to have a big decline in an asset in terms of the number of sales, but the value to go up. That's what we saw in the late 70s and early 80s across the US. In 1981 to 1982, we saw a 10% decline in home sales volume. And we saw a 1% increase in home prices. If I had to guess, this is most similar to where we are today.
Yeah, 2022 to 2023. Okay.
And then the question is, what happened after that? Because once a recession happens, what does the Fed do, Pablo?
Generally lowers interest rates.
It lowers the Fed funds rate, which lowers all the other borrowing costs, which has an indirect effect on lowering interest rates. Why does the Fed do that when there's a recession?
Because when there is a recession, people are afraid to spend money, so they loosen up the money so that people can spend it.
They want to grow GDP. They want to grow the gross domestic product. They want to get the economy churning again. And the easiest way to do that is to bring more money into the economy. And the thing that they have the most control over is lowering the borrowing cost of people and companies. So the effect of it, if you're lowering interest rates, Pablo, what effect do you think that has on housing?
I would assume that it makes prices go up.
Makes prices go up.
Because it increases the amount of people in market looking for a home.
It increases demand.
Yeah,
absolutely.
Demand. Yep.
Because what's happened over the last year and a half as interest rates have done the opposite.
Correct.
They've gone up. What has that done to demand?
It has lowered demand.
It has lowered
because
demand.
now you're buying same amount of home for a higher monthly payment.
Exactly. Well, the opposite happens when you lower interest rates.
Got it.
And this is what we saw across the US from 1982 to 1986. We saw home sales volume go up roughly 57%, which makes sense because there's more demand because interest rates are lower. And then we saw 24% increase in home prices across the US from 1982 to 1986.
Interesting. So you said right here in 1981 to 1982, that's why you think that this is the period where we're just kind of like at or wrapping up, right? And you put a little bit of data behind that.
Yeah, I mean, in my best estimations, that's kind of where we're at right now.
Okay.
So then I started to look here local in Jacksonville. So from 2021 to 2022, we saw a 15% decline in home sales volume, right? The number of homes that are being sold in 2022 was 15% less than 2021. This is what made all the headlines. They called this a crash. That was not a crash because what we actually saw is home prices went up 36% from 2021 to 2022.
Got it.
And here's kind of where we are today. And that's why you can start to see some real similarities between 1981 and 1982. From 2022 to 2023, we've had a 7% decline in the number of home sales in Jacksonville, Florida, but prices are flat. Do you see a whole lot of similarities there between 1981 and 1982?
I do. I see a bigger decline and a bigger increase kind of like running up to it. Then I see a smaller decline with it basically like flattening. And then we see what happens after, right?
And this isn't to say that I think next year home prices are going to go up 24%. But what I know is that when we go into tough economic times, the first lever that the Fed can pull in order to increase economic activity is lowering interest rates. So if you believe that lower interest rates lead to home price appreciation, which is what we see over and over and over again, it should just make intuitive sense for you, then what we would expect to happen is that there will be significant home price appreciation in future years. And I don't know when that's going to happen. There's too many variables to know. But what we believe is that home prices will be higher over the next 3 years versus where they are today. And this is the biggest reason why.
Got it. So you were thinking that we are right now at that stabilization point. In the next short-term window is when stuff starts to kick up because the Fed is only going to hold the interest rate high for a certain amount of time. And it is only a matter of time until they start to lower the interest rates again. And as soon as that happens, we're expecting prices to go up. And you're seeing that in the short to medium term.
I'll give a little bit. I wouldn't go so strong and say it's only a matter of time. I do believe it's only a matter of time, but I don't know how long that's going to last. The Fed has made it very clear that they're going to hold interest rates high for an extended period of time. And that could all change tomorrow. They could see that and they could keep that for 2 years or maybe longer. But what I know is when they pull that back and they start to decrease interest rates, you're going to see home prices go up because simply there's not enough supply in the marketplace to support the demand. And if you start throwing more and more demand on something when there's not a whole lot of supply, you're going to see home prices go up at some point.
Got it. And what do you think the headlines say, GC?
Well, so these are some of the headlines that I pulled, and you're starting to see, inklings of this from other experts in the marketplace. You're starting to read more articles about the lack of supply. Again, if you're a part of our Not Your Average Investor show and community, you've heard this for years now, but the headlines are starting to talk about how home prices have a high floor and simply are going to go up in future years because of the supply side of this equation, which we don't have enough supply to support.
And we do have plenty of data to have that lack of supply. And that is our favorite metric that we've been talking about here that you made famous. March 2020.
Again, I like to do the same things over and over so you guys can hold me accountable, can hold your decisions accountable, right? Get education through this months of inventory metric. Nobody talked about this a few years ago. right? I'm starting to see this more and more in some of the national headlines, which is really exciting.
You were like the Taylor Swift to Travis Kelce's MOI. You put it on the map.
Oh, goodness. I don't even know what to do with that.
While
Oh,
he's
man.
Googling. So tell us about MOIGC.
All right, so MOI. So real quickly here, the way a great leading indicator for what home prices are going to do is the supply side of the equation. If you don't have enough supply to support the demand, you would expect home prices to go up. So in real estate investor expert speak, we talk about that as MOI, months of inventory. What we do is we take a look at how many homes are on the marketplace in your market here in Jacksonville, and we divide that by the number of homes that sold last month. And we get an equation. And if that equation is between 6 to 7 months of inventory, then historically that is an average home price appreciation expectation. You would expect average home price appreciation for your marketplace. In Jacksonville, average home price appreciation is 5% per year. If it is higher than 7, that would mean you have more supply than is needed to serve the demand, and you would expect downward pressure on pricing. That doesn't mean that you expect declines. It just means it's less than 5% is what you would expect over the next 6 to 12 months. And if it's lower than 6, you would expect the opposite. You would expect upward pressure on pricing, and you would expect prices to go up. And the lower you get below 6, the more pressure you have for prices to go up.
Got it. So that is the MOI disclaimer if you've never been to one of our shows or one of our quarterly updates, but this is where MOI is right now. GC, talk us through it.
Yeah, so I go back to September 2021, and you can see we had about 4,600 homes on the market. We had about 3,300 home sales in the Jacksonville market for a month of inventory of 1.4. That is about the lowest in history. Normally, home price, MOI is right in that normal range, call it 6 to 7 months of inventory. So to be in the 1s and now in the 2s as of last year, September of 2022, is extremely low, and holding all else constant, you would expect home prices to go way up. The thing that it's seeing on the other side is the interest rates holding the demand down.
Interest rates holding down demand, and now in September 2023,
you have 7,000 houses on the market, so that hasn't gone completely bonkers. It's gone up as we would expect, but you still have over 2,600 home sales here in Jacksonville. Just to put that in perspective, in June of 2022, that was the first time in Jacksonville's history that we had over 3,000 home sales in a month. So months of 3,000 home sales is very unique for the Jacksonville market. We still had 2,650 home sales in September of 2023 with almost 8% interest rates for the average real estate investor or home buyer, which just leads to the question of what would these total sales numbers be if your interest rates were a little bit lower, if they were 1% lower or 2% lower, which is totally possible in the near future.
I think the story behind the story in these numbers, GC, and I'm not the numbers guy, right? I am the feelings guy, but my feeling is that from September 22 to September 2023, interest rates went up and up and up and up and put a whole bunch of fear. Like that really, really slowed the market down. And I feel right now that interest rates are stabilized. Like right there, what they're talking about is that they're high and they're going to hold high. And the idea that during this rapid rise, it blipped up and then it barely nudged up again during this like really high rise, feels like this number of like 2,500, 2,600 is just baked in, people moving here, people needing new homes in Jacksonville that are buying homes out of necessity, not out of opportunity. And I would have a hard time thinking that, we're not kind of stabilized here in MOI, at least in the short term.
I'll throw a couple differing perspectives there. So interest rates that closed in September were locked in, 1 to 2 months prior. So July, August is when those interest rates were in. You've actually seen significant increase in interest rates from July or August until now. So something to take into consideration there. So I don't really think we're comparing apples to apples there. And then the other side of seasonality is that you're going to see less home sales in November, December, because that's what seasonality is. There's less demand for housing. So I wouldn't be surprised if we have less home sales as we round out the year here. But then guess what's going to happen in February, March, April, May, June of next year, that number is going to go back up. So I think if you were averaging out our home sales, over the course of a year, I think you're probably right. But don't be surprised if home sales go a little bit down from here. That's part of seasonality, and that's part of the dampening of demand effect from the interest rate increases that the Fed has done, as well as the mortgage rate premium, which is something else to consider when it comes to an interest rate.